How's it going, guys? Welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio. And Fabio, what are we looking at here today?
So today we're looking at a grocery store called Albertsons. And basically what we're going to do here today is a preliminary look at the company, and we're going to do that in several stages. First, we're going to do the overview. Then we're going to take a look at the moat. Then we're going to go to Austin. He's going to take a look at the accounting and highlight any green or red flags he sees. Then we're going to look at future prospects.
Let's jump right into it, Fabio.
Yeah. Okay. So basically what Albertsons is that we'll put it up right here on the screen here. Albertsons is a collection of a bunch of different grocery store brands. And going into that, let's go into the moat. So with the moat for grocery stores, the moat basically coincides with their locations. So the location theme. And when you're thinking about what it is that separates one grocery store chain from another, it's the convenience that it gives to the consumer. However, more recently, what do you think has been happening lately with companies like Kroger and Walmart, Austin? You and I have discussed extensively about the expansion of these businesses into certain avenues of sales. And what would those be?
So actually with Kroger and Walmart, especially, they're starting to move sort of towards a e-commerce type of format. So they're having more people do like deliveries and et cetera. And we think that's a potential future prospect of this industry that's quite lucrative and very exciting for us. And so kind of piggybacking from there into the management, Fabio, management squeaky clean. I did not find anything like, convicted prior crimes, nothing. They're completely squeaky clean. But then also a sizable risk that I noticed, and I'll put it up here on the screen right now, kind of getting into the accounting. A sizable risk is that a lot of their employees are unionized. And the reason why this is a risk is because one of their competitors, Walmart, does not have unions. They've been able to successfully stave off these unions. So this here, it pretty much lets us understand, if we go to the balance sheet here, it lets us understand why other long-term liabilities is increasing year over year, even though so it kind of gives us a sense. So then also what we're looking at too, when we look at this balance sheet here, we have inventories that make up a sizable portion of their total current assets, and then property and equipment that make up a sizable portion of their total assets. Fabio, would you say that that's a good thing?
Yeah, for this kind of company in this industry, yeah, it's pretty normal, unless it's something that's out of the ordinary when compared to competitor, which I don't believe it is, looking at the numbers here.
Mm-hmm. And then also too, we also see accounts payable makes up a sizable portion of their total current liabilities. Is this something you would expect to see for Albertsons in this particular industry?
Yes, for this particular industry, you're going to tend to see a higher accounts payable because a lot of the business model for grocery stores relies on a heavy accounts payable model. So basically, they hold inventory on account. And when you think about this, think about the risk that can come into play. For example, if there is a shutdown of an economy and they force grocery stores to shut down, this may hurt them far more than it hurts other kinds of businesses, because a lot of the inventory in grocery stores can spoil, and that inventory will be written off at a value of $0 because you can't sell spoiled food. So that's something to be cognizant of. And then they still will owe that money through the accounts payable unless they have some sort of protections on their end, whether with regards to insurance or some form like that.
Mm-hmm. And then kind of taking a look at their debt too. Their debt makes up a sizable portion of their total liabilities. And Fabio, does that corroborate your theory earlier about accounts payable? And is that something that you would want to see, or is that more of a red flag in this particular industry?
Well, I would always prefer to see a lower amount of debt regardless of the business. But for this kind of business where it's very capital intensive and opening new locations can often be a very capital intensive endeavor, I would say that it's pretty normal. We just want to make sure and keep track of that debt and make sure that's not getting out of hand. And when we look at the company's ability to pay off that debt, we just have to remember that. And as they continue to grow in the future, we want to be keeping an eye on that debt, making sure that management is not being overzealous with their growth estimates of future stores.
Mm-hmm. And so now that we kind of move on to there, it's important to note, Fabio, that actually with regards to property, plant, and equipment, their stores have been increasing since last year. So I would say that's a green flag, in my opinion. What about your opinion?
Yeah, that's a green flag. We want to see some growth in that avenue, but also we want to pay attention to organic growth. So if organic growth isn't quite there, that kind of tells me the efficiency of their current stores. Now, with a company like Albertsons, I would assume that organic growth is moderate, not counting the recent shutdowns of last year, not counting 2020. I would say that it would range between 1 to 5%, and that would be pretty healthy. And you would kind of see those go more or less in line with inflation. And then any extra revenue increases probably comes from new stores.
So interestingly enough, Fabio, when we take a look at the statement of cash flows, we notice that they are cash flow positive with their operating activities. They
Yeah.
themselves have indicated that they believe that they're going to remain that way for the next 12 months and for the foreseeable future. That to me is a huge green flag. How about yourself? What would you think of that?
Yeah, I would highly expect that of a company like Albertsons that's well established. So having positive cash flows is very good sign for us as investors, because it tells us that the business we are investing in is able to then reward us later in the form of capital returns, whatever form they take, in dividends or buybacks. And
Mhm.
it also is something we should look at when looking at to the debt servicing costs and whether they're able to service that debt and pay it down over time.
Perfect. So other than really that, Fabio, the numbers are clean, the accounting is great, and let's move on to the future prospects using the discounted cash flow analysis.
All right, so we'll go ahead and open up the model right now, and we will take a look first, and we'll input the ticker symbol ACI for Albertsons. So before we look at the discounted cash flow model, let's look at the key ratios here. So we're going to look at it in terms of sections, and we're going to see what we see. So currently here, we can see the liquidity ratios, the current ratio, the cash ratio. So the current ratio, we want to see this going higher over time. And again, for everyone, we always have this here on the side to kind of follow along as to what is better. The cash ratio has also been kind of staying around the same, but still pretty good. So the cash ratio is actually pretty good.
That's really good.
Yeah, it's a pretty good cash ratio. There might actually be something going on in the model there, to be honest. But
Mhm.
other than that, we can look at the current ratio. The current ratio is good. We want to see this above 1, but the cash ratio is suspiciously high here. So this might be something calculating on the back end that might
Yeah,
be a
I was
little
like,
off there.
wow,
But the
three.
current ratio is telling me that this is good. They had a hiccup in 2019 where it was under, and I don't like to see that. But for grocery store chains, I typically see around 1, but above 1 is pretty good. And
Mhm.
then the total debt ratio, we saw a decrease in this over time, and that's an improvement. That's good. So
Incredible
that means
improvement.
they've been improving on their debts. And then the long-term debt ratio, the same story shows here. So remember, we're trying to see the story. And what's the saying, Austin, about accounting?
The saying is that accountants are the ones who write the numbers and analysts are the ones who read the story.
So here we're reading the story. So long-term debt ratio going down. That's a good thing. And then again, going down and going down. All these are good, right? Gross profit margin. This is actually pretty normal for a grocery store, pretty
Mhm.
stable. We want stability or improvement. Operating profit. Okay, so this is normal. Grocery stores tend to have a lower operating profit because there's a lot of costs that go into actually supporting the grocery chain, and then the net profit margin is also pretty normal, pretty
Yeah.
low, but actually improving over time. There might have been some costs written down here on a GAAP basis, but still, we want to see this improving over time.
Mhm.
Return on assets, again, pretty normal because of the amount. It's an asset heavy business. So there's a lot of assets that the company holds. And then the net income margins are so low on this kind of business. So this is pretty normal. And return on equity is doing much better. It's actually increasing a little bit, obviously an anomaly in 2020. And we'll see when 2021 finishes what it'll end up at. But we have
Yeah.
to be maybe like think of 2019's numbers as more like the normal rate. So that's actually pretty good. This is kind of this right here is a DuPont analysis, and it's kind of seeing management's scorecard.
Mhm.
And so we're kind of done with this one. Let's move on to this section, see what we can get. So we can see the EPS steadily rising over time. And then
Improving.
one of our favorite metrics, free cash flow per share, rising over time a little bit. Right here, again, we'll see 2021 finish off and what it will be. But we see 2020 again kind of being this anomaly, and 2019 an improvement from 2018.
Mhm.
Going into the last section, this is very important for our grocery store chains. We see inventory turnover. We want to see
Improving.
this going higher, and it
Yep.
improved, right? So inventory turnover, this is basically for our audience to simplify the definition, Inventory turnover is telling us how many times the company is using up its inventory. So in 2018, it used it up 9.87 times. And then in 2021, it's so far for a trailing 12 months of what it's reported, 11.17 times. So again, we want to see this at the end of the year once it's done to get a full picture, but we can take 2020's numbers and say 11.27 times is how much they refilled inventory. And then days sales of inventory, this is how long does it take for them to get through their inventory. And we want to see this going down. So these two are basically efficiency metrics for the management and how well they're utilizing their logistics. So we again see an improvement. Asset turnover, this has been more or less steady. I wouldn't really consider this an improvement or a decay. It's a slight decay, but it's not enough to raise a red flag. And then AR turnover has increased over time from 100 to 119 over the course of these years. Again, 2020 is an anomaly here, so take that with a grain of salt. And we have to still see what 2021 finishes off at. I would use 2019 as a barometer to compare. So now that we've told the story with the ratios, let's actually get into the discounted cash flow valuation. So we already have our ticker symbol in here. It's a profitable business. We have an Altman Z-score of 5.41. That's used for predicting bankruptcy, usually for industrial companies, but it has its use case in regular companies too. It can kind of give us a general idea for a business. And right now we can say, based on everything we've discussed, what is an appropriate required rate of return? I would say we can start off with a market average required rate of return. So let's say 10%, right? The average of the market. And let's assume no buybacks for now. Let's just assume the shares stay the same, even though I think they've been buying back shares over time. So this is what they've done on average. So we're not going to assume anything just yet. So let's assume a decay of 2%, an increase of 1%, a increase of 2%, an increase of 3%, and then 4%. And then let's take a look at these prices that the model is giving us. So essentially, right here, Austin, at a required rate of return of 10%, these are the prices at which we would be interested in purchasing the company. And there's some things about a required rate of return of 10%. We're kind of assuming no margin of safety. We're assuming a market weighted risk. And we're not taking into account that we could be wrong in some instances. So what are some of the risks that we talked about that might affect our discount rate, Austin?
So I would say that really the red flag that stands out to me is the unionization. And because of that, I would like a higher discount rate because we need to kind of discount that risk itself. So for full disclosure, I am a shareholder of Albertsons and I bought the company when it was $23 per share. So Fabio, could we replicate this in the model?
Yeah, we could. So essentially right here, when we did this together, I think our discount rate was 15% and above based on the risks we assumed. And we believe that the business would do not a decay, but around between a 1 to a 5% growth rate. And we also can see on no assumption of buybacks, which is more or less unlikely. I do believe the business will continue to do buybacks over time, that the buy price at the moment was actually quite close. And then you justified, do you think a reason why you justified opening a position?
It was. And then it was also the fact too, that I like to see that this company is acquiring many different companies that can actually support their core business itself. And then also what I also enjoyed seeing about this company too was its attractive price. And then frankly, when we plugged it into the model, it showed me exactly what I wanted to see. So
precisely, yes. So what the model is basically here for is to show us a range of assumptions that we make, and then we adjust what our ignorance risk, right? So then we can see what prices we would be willing to pay based on those risks. For me, I would even go further and even try to get a 20% discount rate. And these are the prices where I believe that if I could get Albertsons, which I think some of these are actually close to the IPO price, it would be a tremendous value for me personally. At a 15% discount rate, I believe that is a fair discount rate for this based on the risks. I don't think that there are too many risks associated with Albertsons. However, now let's play around with the model and assume some buybacks. So let's assume a 4% buyback, which is about a little bit less than what they've done on average.
So Fabio, Could you explain to our audience what the significance of share buybacks are and how that can, in effect, affect the model?
Yes, so that's actually a really good question. So buybacks essentially are a form of returning capital to shareholders. It is another way aside from dividends. Buybacks basically are the company buying back shares and erasing them. So basically think of it like a pizza pie. And when there are less slices, when you cut the pizza into less slices, you get a bigger slice of the pie. So buybacks are essentially making those slices bigger over time. You become a greater owner. So when the company buybacks shares, those future profits that we're projecting, you are going to own a greater percentage of those future profits, and thus they increase the future potential value of the business. However, there's a caveat. You don't want the company to buy back shares at unreasonable prices, because that is a way to destroy shareholder value. Now, if they are buying back shares at a price that you would otherwise be buying the shares at, that's actually indicative of good capital allocation of the business. And you actually would like them to do that. So I would believe that at current prices, based on our current metrics, that the company is more or less buying their shares back at attractive prices relative to what the future performance and value of those shares will be. So assuming those 4% buybacks, you can kind of see how that does affect the prices, because I will go ahead and change them again to a no, so we can see the difference. But then assuming those buybacks again, those are the new prices. And I believe that assuming the buybacks, you can actually get a 20% discount rate on those shares. And as you can see, that's the assumption. I believe that when we were discussing this, when we did open positions in it, it was a 5% growth rate with I'm assuming a small buyback of 4%, so slightly less than what they've done on average. That's what you can get. And then if you could get the price a little bit lower, your margin of safety would be even greater.
So Fabio, all in all, do the green flags outweigh the red flags for you? And if so, would you continue to do further research into the stock and further your due diligence before making any and all investment decisions, Fabio?
Yes, for this company, I do believe it's worth keeping track of. For full disclosure, I own this company, but through my wife's portfolio, not directly in my own personal portfolios. And Austin owns it in his direct personal portfolio. So for me personally, what I can speak for myself is I will actually continue to watch this name and add on any weakness should the opportunity present itself. Or if the story changes or some of the fundamentals do change for the business, I will then rethink my positioning and perhaps even liquidate the position.
So we hope that you guys have enjoyed this video today. We are the Capital Mindset Show. We will be providing an in-depth analysis on our website, capitalmindset.org. As always, for full disclosure, this is not financial advice, and this is for entertainment purposes only. We're your hosts, Austin and Fabio, and we hope that you have a great day.